Okay, we're starting to see some folks fill in, and I'm sure we'll have more join as we go. So, welcome everyone to this webcast. It's exciting. We're really informal. We're bringing some people together to talk about things that we know need to be talked about. In this instance, we're going to talk about capital, fundraising, what's working, what's not, what's broken, what's not. So specifically, we have some experts here that are well versed in both VC, venture studio, M&A, and really just the future of capital. And so that's what this discussion is going to be centered around. With that, we're going to go ahead and introduce some of our experts. We have some amazing people here today, and I'm going to let them introduce themselves because they will do a much better job than I will of listing off all the wonderful things that they've done. I'll start. I'm Molly Johnner. I'll be your host and moderator today. I'm the CEO of Spring and Forge, and I'm going to kick it over to Trevor. And you go ahead and introduce yourself, Trevor.
Yeah, no, I appreciate you bringing us all together for this conversation. My name's Trevor Mann. I'm a co-GP of Pacific Gateway Equity. We're focusing on cross-border deal flow, pretty much vertically agnostic, but we're tying together private pockets of capital between sovereign funds, private equity shops, M&A, VC, family offices, etc. And then debt on the investment banking side, bringing all those pieces of capital together to get deals done. It's the shortest way to say it.
Amazing. Yes. And you always have spicy takes on LinkedIn about revenue and bootstrapping and all the things. So definitely go check that out if you don't. We'll be asking about it a little bit today. JT, I'd love for you to introduce yourself.
Of course. Hi, everybody. I'm JT Benton. I am one of four co-founders of a company called the 9.8 Collective. We place the venture studio kind of at the center of our ecosystem and do all that we can within our power to support venture studios. That also led myself and a couple other folks to co-found the Venture Studio Forum, which is a global nonprofit that supports the venture studio ecosystem and is now the largest global community of venture studio stakeholders. And so thrilled to be here. Very, very thankful, Molly, for the inclusion and eager to have a great discussion.
Yeah, I love that. I love how you have multiple titles. I think everybody on this webcast does. Like there's like multiple ventures. So it's like picking the one that we want to say. But I love you have so many different, very cool things, and they all involve helping people and encouraging people, which I think is important to call out. So, Isa, would you like to introduce yourself?
Yeah, absolutely. And, thank you again, Molly, for bringing us together, inviting me on this panel. It's a great panel here. I'm Isa Kildani. I'm managing partner at Ambrosia Ventures. We're a boutique strategy and M&A advisory firm, really focusing on life sciences. So anything in biotech, pharma, medtech, digital health.
Mhm.
Of course, AI is usually in play with a lot of these different intersections. And we really focus on two different markets. So the founders, startups, anything early stage, mid stage companies, and then we work closely with investors. So private equity, VCs, family offices as well, just to understand their perspectives, advise them on certain deals, and then making sure that we are addressing certain gap that we're always noticing.
Mhm. Well, and his nickname is the professor. To be clear, I've nicknamed him that, but he's got like the professor of numbers. If you have a numbers question, Isa is your guy. So that's how that is. So I'll stop the share so we can just have a great conversation. So let's kick it off. I am going to lob the first question over to Trevor just to kick us off. I think we're all wondering, is VC just totally broken? How can we fundraise in this ecosystem? How can we build in this ecosystem?
Yeah. VC is very different from what it was a few years back when there was a lot of dry powder, a lot of capital, and checks were just being written to anybody that had a decent track record and a good idea. Today, with the capital being more selective, we have to approach VC very differently than, expecting to have investment come at like a pre-revenue, pre-idea stage even. So a lot of what I talk about in terms of establishing the right path for a founder in today's ecosystem is more so about being revenue and client forward rather than investor forward. Like the investors are going to come when you have established the proper product market fit, You have the revenue, and you've clearly identified the pain point and the solution of what your business is actually solving for your customer. But before you have that, it's going to be really hard to actually get checks written from VCs. So that's how it's changed a little bit. It may not be entirely broken, but an aspect of the VC ecosystem today is the scoreboards being misaligned. So how VCs win is these outsized returns. They're playing off the power law model. They know that over half of their investments are going to go to zero. And that's not really aligned with what you're looking for as a founder. You want somebody beyond just the check, somebody that has strategic experience within the vertical, that can help with the business development, has been in your shoes before, not just another Ivy League MBA telling you through a PowerPoint what to do with your business. So there's a lot that has changed within that relationship between the founder and the VC. On a founder side, like how you win is retaining as much equity as possible and growing the business as much as possible with injecting as little dilutive capital as possible. But at the same time, the vanity metrics of, you know, what you see on LinkedIn or what you see on the Forbes list, it's like, oh, this founder just raised a $300 million round, and everybody's celebrating it like it's this great thing, but they gave up 80% of their company before their Series B. And
The darker metrics, what you don't actually see.
yeah, exactly. So that's my long answer, but my short answer is it's broken in ways that you're able to navigate as long as you know how it's changed. And I think the best way to navigate it now is being revenue forward and putting yourself in a position where the money is coming to you rather than you're going out and spending all your time trying to fundraise.
Yeah, I mean, that's another problem, right? Founders are fundraising and they're not building. I feel like falls in your court, JT, because you're focused on helping founders build. Where do you feel like the venture studio model kind of can help in those places where VC is broken?
So it's a great segue. Just coming off of Trevor's comment, venture studios um, we would do well to define them, right? Just to anchor to a definition in this discussion. A venture studio is a company that builds companies, right? And it does so. It plays three really critical roles, and it plays those roles simultaneously. It's a founder or a co-founder of the venture. It is a operator, right? It's taking some of that operational lift of building the company, and it is an investor, typically the first money in. And so it's very often confused or conflated with accelerators or incubators, and it is not those things. The company that builds companies. Well, what does that mean? Well, it means that there are some best practices and playbooks and sort of standardized formats for building companies and de-risking them to the point that they are investable by a more institutional Series A investor or seed investor. And one of the ways that they do that is they prove product market fit. So this revenue forward thing that Trevor's pointing to is just such a great handoff for the venture studio to say, hey, we've developed a thesis, we've launched companies against that thesis, we've proven that the market wants them, we've identified our unit economics, we've assessed the market and been able to identify that there is product market fit and there's actually product market full. Now this is much more investable. And so the studio's ability to build from the studs up a company to that space and then graduate it, right, matriculate it to the next phase, is really the utility that it provides in the context of your question. I think it's really powerful. What's interesting, and you didn't actually ask this question, so like I'll just kind of veer off for a second, is
Yeah, please.
It's not always recognized for that, right? There's a little bit of fear around the studio model, around the terminology. And so you still see biases exist towards studios or towards studio-born startups. But at the end of the day, look, what is it? It's a company that's building companies and it's de-risking them for the next phase.
Are you seeing a lot of, like, VCs investing in venture studio companies? Like, how does that work?
No.
What does the timeline look like? Okay. So
Yeah.
explain the
Well,
process. Like, why would a
yeah.
founder do that versus go for the traditional route?
Okay. So I do see venture studios invest, excuse me, I do see venture capital firms invest in studio born ventures.
Okay.
What we don't see a lot of yet, although it's starting to break down, is venture capital firms investing in studios themselves. And
Oh,
I think that's a charter thing, right? Like they're not necessarily deploying capital into cost centers that aren't the actual venture themselves.
mhm,
But the studio is producing companies that they invest in. So the
mhm,
question is, if you're a founder, right? Why build in a studio as opposed to go out and take the more traditional route and raise VC? Well, let's just kind of break down what a founder does,
mhm,
right? They go out, um, they operate from a thesis, and they try to go prove that that thesis is correct by establishing that the market wants their product and that
mhm,
the profit margin of selling that product is enough that when a sizable enough chunk of the market buys it, we've got a viable business, right?
mhm,
Pretty simple stuff. Build product, ship product, and reconcile with the market. That's what you're supposed to do. If you are a founder on your own, what are you going to go do? And you're going to raise VC capital. Well, you're going to go find office space. You're going to go constantly ask for money. You're going to go assemble a team. You're going to go have to fire some of that team when they don't do their job or rehire some of that team when they get poached by your competition. You're going to be doing a bunch of stuff, right? And I haven't even gotten into the half of it that does not relate to those three things that matter the most: build product, ship product, and reconcile with the market, right? So that you can be that revenue forward investable startup. Well, Studio takes all that away from you and says, look, let's go focus
mhm,
on keeping the main thing the main thing. Let's go prove that this venture is wanted by the world and that it is an economic win and
mhm,
that there's scale behind it. And so if you're a founder who really wants to get right to work and not necessarily cloud your day or your calendar with stuff that is important but not urgent to the viability of a startup, a studio is a great place to build.
Mhm.
yeah, well, and I have a
Yeah.
question for Issa too, though. Like, so thinking about exit because you're like M&A, what what model suits a founder best if they're thinking about how do I exit, right? Everyone wants to be a unicorn. There's like 2. I don't know what the statistics are on that. I should have probably looked it up before the webcast, but it's a very, very small number of companies that actually become a unicorn. But what does it look like to become viable for an exit? And as you build, what supports that best? Venture studio model, VC, something completely different?
Yeah, so it really depends on, especially in life sciences, there's so many different ways for a proper exit, and a lot of it is creativity involved.
Mhm,
It kind of harps on the point on how venture capital really isn't broken. It's mainly, it could be more, poorly instrumented. It could be
mm,
missequenced. It could be mispriced at certain stages too. So, coming from an M&A perspective, where we fit in, especially for our firm, is really fixing that at the company, at the deal, at the fund level, with, proper hard gating, really. So just evidence first, underwriting, engineering its liquidity in the company. So it's a matter of understanding the need, for example, for certain therapeutic, certain health
mhm,
tech or med tech device, for example. It's mainly architecting the plan to a buyer's diligence checklist, really. So it's just making sure that there's logic involved, there's subgroup justifications, there's certain pave pathways for like peer relevance outcomes as well. Making sure that it makes sense for possible other options, for any other M&A optionalities. So a more popular route is licensing. So that's like the first, probably best validation to a possible exit for a company. If there's, for example, options to license is a trending area right now, especially if it's a preclinical asset or like a not fully developed, a fully commercial asset. There's these options of co-developing, doing ventures with larger pharmaceuticals or larger strategics that might be interested in, and then that's where we would come in, and then we help assess, change of control, the governance structuring,
mm,
milestones to give that company its true valuation and then a proper exit if that's something that they see fit. So it is there are a lot of options, a lot of areas to play around, especially if the innovation is there, the team is there, and of course the dry powder, the capital is going to be there.
Hmm. Yeah, that's good. I'm thinking too, and putting my founder hat on. Okay, I'm looking to exit, and really, it's all about control, money and control. That's really what it boils down to. I like to retain as much control of my company as possible, right? Which model fits that? I mean, my question really is like, I mean, Trevor, he can partner with you, and if you navigate it correctly, then you retain control of your company in some capacity, right? You don't dilute completely. But with JT, does the venture studio model take equity? Is there like an
Of
element
course,
of like
yeah,
what we're building? Yeah, so
absolutely. Yeah, so I'll take that one for
please, yeah. I mean, that
okay.
for discussion, yeah.
Yeah. So in a typical or traditional setting, a founder will say, "Hey, this is a business I want to start. I
Hmm.
need some money." Right? In a venture studio setting, it's a little different, right? The studio is going to have a core thesis, and it is either going to develop ventures against that thesis from within,
Hmm.
or it's going to put some signal out to a very small kind of niche group of founders, curated group of founders, and say, these are the kinds of ventures we want to build. Do you want to build with us? Right. But
Hmm.
the studio is going to act as a true co-founder or a founder
Hmm.
of that venture, which means it's getting founding shares. Right. And it's a little weird, right? Because it's not just a person, it's a company
Entity.
that's building the companies, right? It's an entity. But yes, they're absolutely gonna own a percentage of that firm because they really are founding it, right? And they're some of the first money in. They're going to
Hmm.
provide a bunch of operational utility to the venture as well.
Hmm.
So, uh, it for the founder who says, "Hey, I got to own as much of this company as possible. That's my KPI." I wouldn't necessarily say that the studio is the best model, right? For the founder who wants to increase their likelihood of success by building against a well validated and understood problem and have support around them where maybe they won't own as much of the venture as they would if they started themselves, but their equity value, right, is much greater per point because of the validation and the service that the studio provides. That's the right setting.
Hmm.
No, JT, I would say, I mean, even if the venture studio is taking some, founder equity, like at the beginning, the value that it would likely create in terms of the added revenue and therefore the
No
multiple on
doubt.
the valuation for further rounds, you're actually likely diluting yourself less if you go into like your Series A round with more established ARR.
I couldn't agree
Because,
with you more, Trevor.
yeah,
Yeah, I think you're making the point better than I could, and I appreciate that. Because I'm kind of like the studio rep here, but you're absolutely right. I mean, it's what is the value of that equity, not how much percent of the company do you own, right?
exactly. Yeah. So it's
Yeah,
just like, how do we play that game right? And to what degree can we increase our confidence that by making a certain decision about taking on a partner, what like in whatever form of equity it is, like that it's going to boost us for our next round or our next layer into the exit. I would even argue that the venture studio model is likely more effective than like angel groups because the angels play in the same phase of the fundraising process. And like because this VC shift that I kind of opened up with about them being less truly like early stage, like they're investing later. I mean, I imagine there's several founders on this call that are like they've heard, oh, this is like a little too early for us, right?
Yeah.
Like, VCs aren't getting engaged as early as they used to. So the
Hmm.
vacuum that created has allowed a more structured like venture studio to step in and prep these founders and these companies for like a proper pre-seed or seed round. And I think they likely do it better than angel groups do because you don't really know what you're getting in terms of like, the involvement of an angel. But if it's within a venture studio model, it's likely significantly more structured because, like you said, you have a company with the intent of executing on a thesis to build these other startups.
that's right.
And then to
Yeah,
even make
That's
it
right.
make a point with that also with like the angel groups. A lot of angels investors, they are operators, but that also means that their full-time job is some operator role. So even though I have resources that might help a certain founder out, they're not going to be as readily available sometimes, or they won't give, a lot of their attention on, certain um, deal or a certain company, right? Venture studios, you're going to be more heavily involved with them. And also it aligns on their cultural fit too. I think that's part
Mhm.
some of the hesitancy or the reluctancy on founders, having someone come in early with an equity share because, you want to make sure that it meshes well with each other. Very similar to like an M&A deal. You want to make sure that there's a certain culture that makes sense. You guys are working towards the same goal. And of course, the resources you're going to be sharing because you're working toward a certain mission in hand.
Absolutely.
Yeah, it's a great point. I would beware in life of half measures, right? Of partial investments. And, to your point, when an angel investor or anyone says, yeah, I want to help you operate this business
Mm.
if and where I can. There's a lot of ambiguity that follows that, right? Whereas a studio is truly the company building utility alongside you, right? That is their stated reason for being. And so it's an important distinction
Hmm.
for sure.
Well, I appreciate that discussion on like how to build or who can build with you. I do also think a lot of founders, and we had some questions in the chat kind of around, okay, I'm fundraising. Um, how? You mentioned the fundraising process, Trevor, and I think that's really important. I'd love to talk through that because I think like you all three have mentioned like it's a game or it's a process or you're navigating something. Can we talk about that thing and maybe some best practices around navigating it? So how do I fundraise? If I am going to go and build for myself, how do I approach fundraising in this environment?
Mm.
And it wasn't a practice question. This is just off the cuff. So this is real life right now.
Yeah, for sure. Um, I would say, I mean, upfront, the fundraising process, I could answer this very logistically about like what due diligence looks like and like your outreach, but I don't think the logistics answer is going to be as valuable as like a more craftful, like how to go about it. So I'll try to focus on that. Like you can pretty easily look up the logistics side of due diligence in the fundraising process, but the art of fundraising is very similar to the art of gaining your first handful of customers.
Mhm.
So in parallel, like the way that you go and solve the problem for your customer and provide a solution around your like for what your business actually does,
Mhm.
doing that for these investor groups, you have to understand that the venture capital firms, for example, is use that one particular institution, they have a problem you can solve too. They have capital, they have LPs that they have to go and get returns for. They are actively looking for companies to invest in. And if you can provide a solution to that problem, aka like show that your company is profitable and is solving a real pain point, you have to think about going into the conversation as like the buyer. Like you're not pitching
Great. Like flip
to
the script. Like what
yeah,
is their
you're not
problem? I
pitching
love
to
that.
the VC, right? It's like, hey, like I understand that you have to allocate and you can get really granular with this and be very thoughtful because there's certain like vintage funds and like in the first year of the fund being raised, like they're really throwing capital. And then on like the middle of the fund, they kind of slow down. And then at the tail end, if they have any dry powder left over, there's mandates within that fund that the funds have to be allocated, right? So you can play the game a little bit more thoughtfully if you understand the funding cycles of VCs and their incentives and requirements to allocate said capital.
Mhm.
Um, Another note just on the how to be strategic with it. I've had founders reach out to me trying to talk about something that is completely outside of my vertical.
Mhm.
Like on our website, I talk very specifically about what verticals are of interest.
Yeah.
And I very clearly state like we only look at deals that are post revenue. That's just where we're at. That's our thesis. You as a founder are absolutely wasting your time if you are trying to set meetings and just have conversations with VCs to have conversations.
Yeah.
Be targeted, be thoughtful, and just do a little bit of research up front.
Mm-hmm.
That is going to position you very well moving forward. I've got a couple other ideas I could share, but I want to give space for Issa and
Sure.
Casey to jump in there. I may add like one or two more points on the craft of
No, those are great.
getting fundraising done.
Issa, do you mind if I jump in with
Go ahead.
some thoughts?
Yeah.
Molly, I guess I should ask you as
Do it. Go. This is a discussion. I love it. Go for it.
awesome. So I can speak from the studio perspective, which is a really hard thing to raise for, and we spend a lot of time in our business and in our ecosystem helping people unlock this. So, and this is very like these are the tactics, right? That form a good strategy. The first is thesis, right? Get really, really tight. At and very well sort of organized around leading with a simple to understand thesis,
Mhm.
right? I'm building companies to solve this problem, right? Leveraging this thing that makes me this comparative advantage to this type of outcome, right? Really, really tight.
Mhm.
So that's the what, okay? And use that thesis as a platform for dialogue. It is so critical that fundraisers understand that you are not an attorney presenting your final argument to a jury. No one is going to hear you monologue them and then give you a check. It just will not happen, right? Your goal is dialogue. So with a thesis in hand, right? Now you got to get into like who is actually the right investor. So if I'm building pre-revenue companies and I want investment, Trevor's not my guy, right? It's on his website. Why on earth would I waste his time and the goodwill that it takes to like get introduced to him?
Yeah.
I got to go find my archetype. Who is it that my thesis is going to be a really good fit for or for him? Right. So then I'm thinking archetype. Again, the next piece is dialogue. So I always like to be very educational and very segmented in my communication with investor prospects and say, hey, listen, I'm exploring this thesis. You seem like a person who would be a really good resource to me in sort of like stress testing that. Can I share that thesis with you? I'd love your feedback. Do not get defensive. Take your time, provide the education that is
It's
necessary for
hard
that
not to
dialogue.
take it personally. I'm going to throw that out there. It is.
Super hard.
It's
Yeah.
tough. That's a whole
Yeah,
thing.
but like, what does it ever want anyone? Right. What,
Oh
like,
no, I
what,
agree. I'm just
you
saying
know what I
that
mean?
taking the emotionality out of it is important on one hand, but then some people tell founders it's all about your story and your passion, and then it's like okay, but there's the emotionality is back into it, so it's hard
So
not to take it through.
I totally agree with you. I have a different take though, which is like, yes is a great answer. No is a good answer. No answer, which is like the modus operandi for most,
Yeah,
is the worst possible outcome. So if I'm
Mhm.
hearing no, cool, right? That's the
yeah,
second best outcome I could get to today,
better than being
right?
ghosted.
Rather than being ghosted. And so that's that dialogue piece is I'm just going to like, I really want this to be a relationship and I want to make it, I want to make it clear to my prospect that this is going to take a minute, right? And we're going to go through this. And then when it does come time to sort of secure investment, I'm an incremental trust advocate, which is like, hey,
Mm,
I understand that you are interested. Others are as well. Can I count you in theoretically? Can I count you in provisionally? Right? Can we put a number against that? And then there's some to dos I have to help you with the diligence. But I want to just what I don't want to do is spend 6 months with somebody on this one big yes that I have to get and then learn it's no. I'd like to incrementally kind of like work towards it.
mhm.
And that's how I go about kind of the fundraising discussion, whether it's for a studio or for a fund or for anything else.
Yeah, no, that's good. Issa, did you have anything to add to that too?
Yeah, actually, they both make really good points, especially on dialogue, on the right person, the archetype. I think some points to add through that on the archetype. I guess a lot of it is timing too. You know, of course, founders they need to look for fundraising. You know, X date, right? And then they're asking all these investors, and maybe they're not coming up. They're coming up short, right? a point to consider too is that a lot of investors, they are uncertain timing as well. So for a founder, even though that they, have a certain timeline, the key there is the dialogue and the story and how long the traction takes. So maybe you have a initial conversation with the VC, maybe it's too early or it's not it for them right now. That no doesn't necessarily mean we're not interested at all, period. They might have already invested all of their investments for the year. Maybe they done all their follow-on reserves. Maybe that their fund right now, they're raising for a new fund. So right now it sounds like a great idea, but they just can't. So being able to continually have these updates and discussions with them is going to possibly prompt, a further discussion, probably a certain, diligence, a capital call. So it's just the persistence. That's the hardest part for a founder is just hearing the no's, the no answers, but going through that process. And then also part of the dialogue too. I see this a lot in life sciences. A lot of founders are scientists, first. They're not really too many of them are from business. So they have a, um, they have a, they have a way of being very passionate about their own science. So sometimes they go a little longer. They speak too sciencey to a lot of investors who might not have that experience. So after 3 minutes, you bored them. They're not interested. It turned into a whole pitch and they almost a whole scientific forum. They don't want to deal with that. Like they can't,
Yeah.
uh, you know. So it's a matter of flushing through it, make it conversational, make it easy to understand, something very quick and easy. And then, getting involved with your community. That's probably it sounds very generic, but it's so true, especially if you're in a bigger market size, like the LA, San Francisco's, the Bostons, the New Yorks of the world, but even smaller areas. I'm from Detroit. The life science scene here is very small, but there's a great community here just because you interact with all the players, the different players, all interact with other founders, speaking with other, accelerator programs, studios, possibly. You meet in the ecosystem. And even though maybe that investor might not be the one for you, they're easily can connect you with someone in their ecosystem. So it's just a matter of being active in your community, going to events, going to the networking cocktail hours and so on and so forth. That's the hard part of being, a founder. You have to be in operation mode and then you have to be in operator mode and you also have to be in this visionary strategic mode, thinking, okay, in 12 months we have our runway ends. How are we going to get there before that? So it's a constant battle. And even if you do get your funding, you still have to be in that mode because, today's money is not going to promise for tomorrow.
Mhm. No, that's a great answer. And I know you mentioned updates, and I know Trevor was going to chat about that a bit too. I don't know if you want to chime in, Trevor.
Yeah, I'll jump in on that. But before that one point, I mean, Issa said something that rang true. For the technical founders that are listening to us, do not read me your PhD thesis on why your product works. I'm trusting you that I know it works, that you know it works. What the VCs need to understand is how that product is commercialized and the actual searing pain point that it solves for your customer base. Like you have to convert and translate your technical understanding into layman business terms. It's like you need to tell the opportunity story. Like how is this going to grow? Like what's the size of the market? What's the opportunity? Right. You need to tell the financial story bottom up. Be like, hey, like if we do X amount of product, X amount of clients, this is what it means for us year one. Build that story.
Mhm.
And then you have to build the credibility story. Answer the question like, why me to solve this problem? Why now?
Mhm.
All right. So anyway, that's just side comment there. Issa, what you said made me laugh because I've heard many, many technical pitches, and I'm a smart guy. I'm not as smart as like some of these PhDs in life sciences or that are coding and stuff. So like you have to know your audience, right? But the investor updates, that's another good point you made. So throughout the fundraising process, like even if like you're getting no's or like not nows, if you go back either on like a monthly or quarterly basis and just kind of show the scoreboard, it's like, hey, since we last talked, this is what we've accomplished. Show the growth, create momentum there. In the same way, you can utilize your social media to attract investors and customers simultaneously just through the awareness of the problem that you're solving. So use it like a scoreboard. Use it like um, the very top of funnel to talk about awareness of the problem and just do education around that, because you as the founder, you're the brand leader. You're creating a movement around yourself. Don't post off your company page. Nobody reads it. You have to
No one subscribes to my newsletter? What are you talking about? They don't want to read that, all my updates?
Yeah.
I'm reading it.
You do.
I'm reading
That's
it.
good. I haven't actually written it, so let's
I'm
go.
the one. I'm the one.
JT is loyal, but for most people, like they want to connect with a person, not a company logo. So you have to lead that as the CEO founder. And then just one final point in the fundraising process up front. By far, the best way to get in front of investors is through other founder introductions. It's not going to be a cold email. It's not going to be some networking group or whatever. Like, if you get introduced to me through somebody I've already given money to, I'm going to take a meeting with you.
Yeah.
Simple as that.
Yeah, no, well said. Well, we had a live question too. I want to make sure we grab that. It's for JT. What other services does a studio offer to founders? So I think you read that question in the chat too, JT, but like examples today, HR, marketing, just for the sake of everyone else.
Yeah. So this is going to vary quite a bit actually, and it
Okay.
shouldn't. But the studio model is evolving, and there's a lot of ambiguity out there as to what a studio is. It's one of the reasons that we started the Venture Studio Forum, was to give this thing a name, right? And to say, hey, these are the standards. So I'll go back to that definition, right? It's a company that builds companies, and it plays in three roles. It is a founder or a co-founder, it is an operator, and it is an investor. So on the operational side, which I think is like the heart of this question, my answer is that it should do as much as it possibly can to limit the scope of what the founding team of the venture is doing to the most critical vectors of company building, early stage de-risking.
Good answer.
I'm like this broken record, right? Build product, ship product, and reconcile with the market.
Yeah.
If we can let founders do that, right, they are going to move at warp speed and build fundamentally sound companies. And when they realize that there isn't a fundamentally sound company to be made, they'll kill it. And they'll go build something else that does fit that, because the confirmation bias that a distinct founder will have should not be present in a studio setting. We're going to take lots of shots on goal, and we're going to find the ones that work, and we're going to go, we're going to double down on those.
That's really good. I like that. I like the shots on goal. That's important. I want to shift a bit because, I want to cover international since we have, so many folks here who have worked internationally, and Trevor in particular. And I want to talk a little bit about, okay, for international founders coming to the US market, I talk to them every day, especially working in defense tech. How do I sell to the US military? How do I sell to the US government? It's a question I get all the time. What are the biggest barriers to raising capital, or what does that look like? I know that you do that quite a bit, so I'd love for you to just answer that here.
Yeah. Biggest barriers to raising capital. I mean, of course, like you mentioned in like defense, there's going to be some vertical specific challenges, but I want to go broader to try to keep it more applicable to everybody. So, like, of course, my logo back here, Mount Fuji, like I clearly do a lot of work with Japan. And the Japanese founders that we're working with that are trying to come into the US market on a fundraising side, there's a lot of cultural barriers in terms of speed of growth and risk, especially like in Japan and APAC region. So anything far east, they're going to be much more conservative, not as willing to take on more risk in order to grow. They would rather have like a slow and steady growth. And a lot of their IPO activity, for example, is earlier than what we see like on the New York exchange. So there's historically been like a fundamental misalignment in how the US venture ecosystem wants to see companies grow versus how companies out of APAC are growing. So a lot of the consulting work that we do with the founders trying to break into the US market
Mhm.
is more so leveling the cultural and business norms and expectations coming
Mhm.
into the US. It's not a total capitulation of like what they're used to and just like, hey, like catch up to speed over here in the US. It's more of a you need to understand how the US investors are thinking about growth in companies, and you need to communicate a more global strategy and a slightly more aggressive pace
Mhm.
that you're willing to build at.
Mhm.
The advantage there, you know, I'll continue to use the APAC example. These companies are typically bootstrapping for significantly longer before they even put anybody on their cap table.
Mhm.
And they're able to leverage that if they communicate it properly to say, hey, like we've built this business, we have the systems, we haven't taken on any risk to do it. And now we can just pour fuel on the fire because we've guarded the business system so well. Like we have established product market fit. Now let's break into these new markets and dump capital into it in order to capture more of the market share.
Yeah.
So that a challenge at the surface level for international founders coming into the US market can actually be communicated as an advantage.
Mm.
All right. You just have to know how to do it. Um, and then on the flip side, for the capital partners that I work with out of the US that want to work with international founders, I
Mhm.
have to do the opposite. It's like, hey, like we have to communicate with patients here. Like the decision making process is going to be slightly slower. It's going to be more relationship building up front. It's less transactional. Like if you want to invest in Japan, you have to make sure that we do X, Y, and Z. And if you do anything to make them feel disrespected or embarrassed, especially,
Mhm.
you're going to lose the deal entirely. So a lot of it's around cultural nuance categorically. That's one of the biggest challenges, but that can be overcome through good communication. Um, and then I guess the other categorical challenge is just scale of the company and like the speed of growth. But I'm seeing a lot of change in that recently. There's younger generations of founders coming out of Japan and the rest of APAC as well, that are more globally minded. They're not just looking at,
Mhm.
capturing the Japanese market. They're looking at global growth and dominance immediately. And some of those companies are going to be some of the best in the world in the next decade. So just want to utilize that as an example.
Yeah, that's great. Did anyone else want to add to that answer that question? I think I feel like, one of the things that you talked about, Trevor, is, building solid, stable companies.
Mhm.
And that's what I hear when I hear like investing overseas and like building something that has foundation and stands. And I know that, some of the questions we talked about before this that you guys were excited about were, we're talking about how do, venture studios or traditional venture categories or like flyover industries, overlook sectors, how do they help or how do they withstand downturn? Right? How are we kind of building so that they don't flame out, for lack of a better
Question.
term?
Yeah,
Mhm.
I love that question.
Who wants to go?
Well,
Throwing it out
what's
there.
that?
Who wants to
What
go?
is
Throw it out there.
happy to go whenever, but also don't mean to
Yeah.
filibuster. I'm a middle child, so it comes naturally to me to take the mic, but I can go later. So if anybody's got a
Go,
hot take
JT,
here.
go.
Okay. Look, I don't think there's anything sexier than a company that makes money, right? Like, sorry, that
Simple.
right, like, or more investable, right? Like from a business fundamentals perspective, a company that goes out and says, "Hey, look, these are my unit economics, and when I apply them at scale, I overcome this J curve and I make money perpetually, and that's how I treat my investors." The the reality is, venture is that we've kind of gotten away from that because of the power law investing model that has been talked about on this call already, which is like, yeah, I'm not interested in singles or doubles. I'm looking for grand slams. I'm looking for
Yeah.
these big outcomes, these unicorns. And so anytime we talk about anything related to venture building, we might conflate, right? Or heuristically snap to like who's building unicorns. I think what studios do is they act as a company building mechanism or utility pointed at a given type of outcome, right? And so I'm visiting this week with a studio that I co-founded with a couple of partners that is entirely focused on building sound, fundamental cash flowing businesses. We're not necessarily chasing unicorns. We're just trying to
Oh.
build companies that can pay dividends to their investors. And that's a really exciting thing to be working on. The model also travels to social impact or regional economic development or commercializing IP that came out of a research institution. It's just a way to build companies as opposed to it only builds these kinds of companies. And so we just look at it as a horizontal rather than a vertical, like company building utility that is more effective.
Yeah, well said. What are you seeing, Isa, in terms of companies that are being built well that don't flame out? What are some of the things that you see?
Um, a lot of it comes to how, I guess, flexible and adaptable, probably malleable, the founding team is. Maybe one strategy doesn't work or a product doesn't work. They didn't see that there's a product market fit from, investors that they're hearing, just, from payers, whatever. They're easily adaptable to change direction and go towards that new, product, whatever they think the market seems. Being able to, make every connection they could think of, just being almost like a hustler mindset. I like to say, like, are always thinking of how else they can generate traction, connecting with new people. Like I've known, we advised some startups that, you know, they were looking for funding, or they were, very early stage, too early for us sometimes. And a year later, they have, pilot programs with Medtronic. They have pilot programs with, globally recognized companies only because of they know that they believe in their technology. There's different areas that they can add, new capacity expansions to a feature, new feature additions, new populations they can connect to, different partnerships. So they're always like they're changing. It's almost like it looks like it's horizontal, but they really are making these vertical jumps in the company just on who they're affecting, the geography that they're affecting. So it's just a matter of, you know, it's answering the same question, but it's in just hitting it in different ways. And at a certain point, you're going to get to that inflection point, wherever that might be. So, they don't take defeat and they don't just sit on it and then they reevaluate the team. Maybe they drop people from the team. I've seen that from a lot of scary stories, I guess, from startups. Or maybe there's a CEO who doesn't like to take advice from even their own internal team, and that hurts their own personal growth. Even though they have a great technology, there's them not understanding that maybe I'm not thinking the right way. So it's a lot of it. It could be a cultural area. Some of it is just understanding or just experience in the industry already. Maybe there's someone that has been in the industry for 20 plus years and they see certain things, so they're open to taking the advice. So it's just a lot of I see those patterns. That tells me, okay, this company is set for something a lot bigger. They're willing to take, have their stake be taken, have 40% gone. Maybe they're only holding 15, 20% of their own company. They just know that they believe what they think is going to be valuable in the end is going to. So those are the companies I see, unicorn potential, basically.
Go ahead, JT. You look like you wanted to say something there.
Yeah, I just got so excited when I was listening to Lisa talk about some of this stuff. So just a thread I want to pull on here is we sometimes confuse conviction with like with being an overall and like universally positive thing. But one of the things that makes companies resilient to downturns is the ability to learn and to understand that while they may have chosen the right target, they maybe didn't choose the right path. And so they're willing to pivot quickly when something didn't work without giving up the entire strategy. And so I think being a target backwards thinker at the management team level and being able to say, hey, this is where we got to go, but we may not necessarily always know how we're going to get there. So we're going to try some stuff, and we're willing to change, right, in our and be fluid in how we get there. I think is a really critical element of a resilient company. And from the outside looking in, it's like, oh, they must have been really hard headed and dogged about pursuing their goal, and they just got, they blasted right through it. And it's like, no, they probably were wrong 7 times and right on the eighth one, and that's
Yeah.
cool too.
Yep. I actually have a good quote. I read this somewhere else. It's Winston Churchill. He says, success is going failure to failure without losing your enthusiasm or joy. And I was like, that's exactly right. Like, how do you go? That's what success looks like. Like you said, it's you get it right in the eighth time, but you didn't give up and you didn't lose that enthusiasm along the way. So that's
Right.
a good point. Yeah. No. Okay. So I know we're coming up on time. So I want to wrap up and do a couple like last minute kind of dig in deeper on each of your specific areas really quickly. So, kind of in like a minute or two, these are what these questions are for. Like, give it like a minute of space, minute or two space. So, Issa, I'm going to start with you because you are my quietest panelist and you let everyone else speak. So, I want to make sure we give you time to say a few more things. So, specifically, if I don't mention AI, then is this even a webcast? Probably not. So I need to like put that in here at the at the end. So we hit all the buzzwords. But with all the AI noise out there, what separates a biotech company that's just kind of sprinkling AI into a deck or one that's actually building from like a defensible world-changing platform? I think that's important.
Yeah. So, I mean, there is a lot of noise that you're seeing in AI, and of course, it's everywhere. You go to a given at any given conference, you're seeing 60 to 100 vendors, pitching their own AI SaaS platform. Those I think are a little dangerous, especially in this field, just because it is noisy that it's not really solving a problem. Like we're seeing stuff in biotech, pharma, where it's being applied correctly, where AI technology is being used to help reduce toxicity screening, helping with drug discovery, helping with biomarker discovery. It's actually pinpointing targets or even just therapies that scientists, on a team of 50 would have taken, months to a year when this is only takes maybe a couple minutes. I've met founders who have AI platforms that are able to discover rare disease platforms or assets in a matter of minutes, over hundreds and thousands in just minutes. So those are really beneficial because now you're pinpointing, you're making it more targeted and you're making it more focus driven for the scientists, the engineers that are actually working on this, and is pushing towards more efficiency. It's taking it, of course, at the end of the day, is to the patients. So how fast can they get these therapies to the patients to impact them, right?
Mhm.
So that's what I like to see, and that's what it should be for. And of course, there are AI platforms and softwares that are very useful for productivity, for like workflow, for project management things, but a lot of what you're seeing is a lot of different variations in that. And one is not different than the other. It's
Are you
just,
sure? Have you seen mine? I
well,
feel like that's the in your inbox. You got like 12 and they're all
yours
different.
is different. Yours is completely different, right? The ones that you see like are the ones that are just, like a chat GPT basically.
Yeah.
It's just a chat
The
GPT,
rapper.
you know, and, and they're framing it as like they're solving a problem in wherever it might be. So that's like the issue, but it's of course it's going to come with anything that's buzzing. you're there's always something that's very popular. There's always going to be those in the mix that are going to try to make their own way into the field however they think it's applicable. So yeah, it's just a matter of doing your own diligence on it and then understanding at the end of the day, AI technology, it is useful, but it has to serve you know a good cause.
Yeah, no, well said. Anybody else have AI thoughts before I move on to the next final question for JT? There's probably a lot of AI thoughts, but we don't have to
I'll
necessarily hit
hold
it
my tongue.
on.
I am AI. I mean,
You
I'm not
are.
even real. I'm not even a real person.
Let me check with ChatGPT. Okay, JT,
Picture.
my question for you. So I've actually heard this a couple times. A lot of institutional investors or others may not necessarily recognize venture studios as like a true asset class. So I would love for you to kind of talk about that a little bit. So you're in the front, obviously advocating for them. What do you think it would take for them to be recognized? in that
We're
way?
doing it right now. It's the most important work we'll do as an industry. We had to give venture studios a name and some parameters around what that means and what it doesn't mean. So you've already heard me kind of like beat the drum. It's a company that creates companies, that plays in these three critical roles. When we set those parameters, now we can say, okay, this is the thing, right?
Hmm.
That's what this is, a venture studio. That's the thing. That's the noun. Let's now go look at what the venture studio asset class, which we've named and defined, looks like from a performance perspective against the other things you might have conflated it with prior to this knowledge, this epiphany. And when you do that, and when you look at the performance data, which is still earlier than, and maybe less mature than some uh, more kind of established asset classes, the story tells itself.
Yeah.
These venture studios build companies with more sound fundamentals. They are de-risked and they are ready to scale,
Hmm.
and they outperform their peers that are traditionally venture backed, right? So we gotta standardize those definitions and frameworks.
Yeah.
And we got to tell the story, and we have to build community around this asset class. We have to make it an asset class. We have to drive the transition from ecosystem to well understood asset class. And for anybody who's here or listens after the fact and is like, okay, cool, what does that mean? Here's what it means. Join the Venture Studio Forum. It is a global nonprofit. We give away everything, all of our resources we make available to venture studio stakeholders across the world. We're in like 95 countries. We've got almost 1,400 members, and they're all there to lift one another up and do what I just talked about.
Yeah.
Give it a name and advocate for it.
I love that. Well said. Well, Trevor, you are the conclusion. So we got a question for JT. We'll come back to questions at the very end. I have one more question for Trevor. You talk about building sustainable companies. You've talked about driving revenue. I think what I would really love to know is in the next year, what does sustainability actually look like? What does that look like in today's environment with everything that's going on in the economy, everything that's going on with tariffs, everything that's going on with the new administration? What does that look like?
Yeah, and just to clarify on the definition of sustainability, are you thinking more just like resilience of the company itself, like independent of
Thinking like
its.
I'm going to be around in 10 years. Like I'm going to be able to make it to a decade.
Gotcha. Yeah, and in that perspective, I mean, it's very basic, just fundamentals. It's having your profit margins, it's having like your ICP down very, very well, your pain point that you're solving, the product market fit. It's all the fundamentals that we've talked about within an evergreen vertical or an evergreen pain point that's not going to go anywhere. There's going to be outside factors like COVID happened, a lot of businesses shut down, but a lot of businesses didn't shut down.
Hmm.
There's going to be economic challenges on a macro level that we have to navigate no matter what. There's going to be political turmoil. There's going to be wars. There's going to be
Yeah.
shit that happens. And we have
Cutting
to.
that out as a quote. That's all it's going to be on social media. There's going to be shit that
There's gonna be
happens.
shit that happens.
Yeah.
The shit's gonna happen, y'all. Yeah.
Yeah. And as a founder, like you just have to persist. That's why in the long run, like we get compensated so well. Like we're solving problems that nobody else took the risk to solve. And there's going to be unknown risks that you have to go through to continue on. So the sustainability of a company, I mean, in some technical aspects, it's all of the fundamentals that I spoke about, but a lot of it's around like the qualitative values of the founder themselves. And that's a big piece of what you can focus on. So like focus on what you can control. I'll try not to sound too stoic here, but focus on what you can control and just move forward with faith, knowing that like you're on this mission for a reason. Like you are
Well said.
solving this problem for a reason. You've been called to it and nobody else in the market is doing it. So you owe it to yourself and all of the people you're solving the problem to continue on no matter what the circumstances are.
That's a really beautiful conclusion. I feel like I couldn't have asked for a better way to end that. And amen. Yeah, exactly. That was really well said. We have a lot of questions actually in the chat. We're not going to get to all those. So if you've asked a question, I will make sure that all of those are sent to the panelists and then they can respond in kind. And I just appreciate everyone's time today, all of the expertise. I think we're probably going to have a follow-on. There was so much to talk about and so many engaging questions. So if you want to connect with our guests, please do that. Trevor, JT, Isa, connect with me. We're happy to talk and further the conversation. And we just are really thankful for everyone who joined. I'm thankful for all the panelists. So thank you for your time.
Thank you. Thank you for having us. This was a great.
Thank you, everybody.
Okay.
Thanks so much. Be
Thank you
well.
all. Okay. Bye.